Let's say you did everything right. You maxed out the 401k for 30 years. You left it alone. You let it grow. And now you've got, say, $800,000, maybe $1 million, sitting in a traditional account. Here's the part nobody warned you about. There is a tax bomb in that account, and it has your name on it. It goes off the year you turn 73. Not because you did anything wrong. You did it right. That's exactly why it's there. I read through the rules so you don't have to, and I want to walk you through how this works, who it hits hardest, and how you diffuse it before it's too late. Stay with me, because the window to fix this is smaller than you think. So let's start with what's actually happening at 73. That money in your 401k or your traditional IRA was never taxed. Not when you put it in, not while it grew. You made a deal with the government. Pay me later, you said. And the government said, fine. 73 is when later arrives. At that age, the IRS makes you start pulling money out, whether you need it or not. That forced withdrawal has a name. It's called a required minimum distribution. The amount isn't random. They take your balance and divide it by a life expectancy number. At 73, that works out to about 3.77% of the account. On $1 million, that's roughly $37,700 the first year. And here's the quiet part. That percentage doesn't stay still. It climbs every single year you're alive. Now, why do I call it a bomb instead of just a tax bill? Because of what it lands on top of. By 73, you've probably started Social Security. Maybe you've got a pension. That income is already coming in. It already fills up your lower tax brackets. Then the RMD drops on top of all of it. So the money that was supposed to be taxed gently in your low-income retirement years instead gets taxed at the highest rate you'll see in your 70s. Let me be clear about one thing, because it matters. A higher bracket only taxes the dollars inside that bracket, not your whole income. That's the honest version. But the RMD still pushes more of your money up into that higher rate. And it sets off two other traps most people never see coming. Here's the first hidden hit. Your Social Security can get taxed because of this. Once your income crosses certain lines, up to 85% of your Social Security check becomes taxable. A big RMD is exactly the thing that pushes you across those lines. So the forced withdrawal doesn't just get taxed itself. It reaches over and taxes your Social Security too. Here's the second hit, and this one surprises people. It's called IRMAA, and it raises your Medicare premiums. When your income goes up, Medicare charges you more for Part B and Part D. And it's a cliff, not a slope. $1 over the line, and the whole surcharge kicks in. Worse, it runs on a 2-year delay. The income from your RMD at 73 sets your Medicare premium at 75. So one forced withdrawal can quietly raise 3 different bills at once. Now, I need to tell you about the cruelest version of this, because nobody talks about it. It's the widow's penalty. Right now, if you're married, you file jointly. Your brackets are wide. You've got room. When one of you passes, the survivor files as a single person the very next year. The brackets roughly cut in half. The income lines for taxing Social Security and for IRMAA, they drop too. But the required minimum distributions don't stop. The money's still there. It still has to come out. So the survivor is left with nearly the same income, taxed in a much smaller box. Same dollars, far bigger bill. For a lot of couples, that's the harshest tax year of their whole retirement, and it arrives in the worst possible week.
Let's talk about what happens if you just ignore the RMD and hope. Don't. This is one of the steepest penalties in the entire tax code. Miss your RMD, and the penalty used to be 50% of what you should have taken. The recent law softened it to 25%. And if you fix the mistake quickly, it can drop to 10%. But think about that. Even 10% for forgetting a deadline. And there's a trap built into the very first year. They let you delay your first RMD to April of the following year. Sounds nice. But then you have to take 2 RMDs in that one calendar year. 2 years of forced income stacked together in a single tax return. That little bit of procrastination can cost you more than the penalty would have. Okay, that's the bomb. Here's how you diffuse it. And the good news is, you have real moves. The most powerful one happens in what I call the gap years. That's the stretch between when you stop working and when you turn 73. In those years, your income is often low. No paycheck. Maybe you haven't even started Social Security yet. That low income window is gold, and most people waste it. This is when you do Roth conversions. You move money out of the traditional account, pay the tax now while your rate is low, and let it grow somewhere the RMD can never touch it. Every dollar you move out is a dollar that won't be forced out later at a higher rate. There's a second move if you give to charity. Starting at 70 and a half, you can send money straight from your IRA to a charity. It's called a QCD. It counts toward your RMD, but it never shows up as income. So it dodges the Social Security trap and the Medicare trap at the same time. And one more. Delaying Social Security to 70 does 2 jobs at once. A bigger check for life, and it keeps your income low so you have room to do those conversions before the bomb goes off. So here's what I want you to walk away with. The bomb isn't the saving. You did the saving, right? The bomb is waiting until 73 to think about it. By then, the balance is as big as it'll ever be, and you've got no low-income years left to work with. But if you start in your 60s, in those quiet gap years, you can take the same money out slowly, on your terms, at a rate you choose. That's the whole game. Not avoiding the tax, choosing when you pay it. Pull up your traditional balance this week. Find out what 3.77% of it is. And if that number makes your stomach drop, that's not panic. That's your head start.